Morning and welcome to the latest installment of the Direct Advisors video podcast series. I'm Jeff Ricciuti, the Chief Investment Officer of Direct Advisors, and I'm delighted to have a special guest with us today, Chad Kilhefner from Vanguard Retirement Plan Access. Welcome, Chad.
Thank you, Jeff. Thank you for having me. Pleased to be with you today.
Thanks for joining us. And I just want to take a minute here to introduce Chad and have him talk about who he is and the Vanguard organization and how we've partnered together in the past. So take it away, Chad.
Great, thank you. So my name is Chad Kilhefner, as Jeff mentioned, and I'm a regional director with Vanguard. So I primarily focus on working with financial advisors and small businesses on establishing retirement plans, really in the area of startup to about $50 million in assets. So I've been with Vanguard for 18 years. I love what we do in the retirement plan and investment space. I really believe that 401ks and retirement plans are the lifeblood of savings for average Americans. When you think about, the industry and the landscape out there, small businesses really represent over 97% of all the businesses that exist out in the United States. And over half of all private sector employees are employed by small businesses. So when you think about the savings opportunity and being able to give people low cost, high quality, platform and the best chance for investment success, to have investments work for you, to keep low costs on your side, and to really, endure that, to secure a established retirement, that's something that I'm personally passionate about and something that I really enjoy doing as far as whether I have the opportunity to talk with people like Jeff and the business owners that I speak with every day. So Vanguard's a firm we've been established since 1975. We're a large investment firm in the industry and a large retirement plan provider. We do have about $6.9 trillion under management in terms of client assets. It's unbelievable to say that number, but we feel very humbled and privileged to be able to, shepherd and safeguard client assets who entrust us to do the right thing with them. So, we are very established in the retirement plan space. We have over 1.3 trillion in defined contribution plan assets and millions of participants, over 5.6 million participants. So that really gives us a great lens into the industry to understand participant behavior, the needs of businesses, large and small alike, and to really help people understand, what the pitfalls and, some of the advantages are, in the industry and in the marketplace. And it's our, privilege and opportunity to be able to help set people on the right track to have them establish or achieve that secure established retirement. So that's a little bit about Vanguard, a bit about me, Jeff, and excited to talk about our topic today in terms of, what to do when the markets don't cooperate and when they do go down, which inevitably happens.
Yes, and thank you, Chad, for the intro there. As you said, we really wanted to spend our time today talking about what to do when the markets drop. In this case, we're talking about a drop of 20%. We thought it was a timely topic in light of what happened back in the spring due to the pandemic. And it's something that we see every so often. And I know when I'm sitting down with participants and going through a risk tolerance exercise, it's a question that we do bring up every time is how would you react if the markets drop 20%? And it's really a way to help gauge, what someone's risk tolerance actually is, because that's really a breaking point for many people as far as when emotion can take over, is when you see that 20% drop, a lot of people start to maybe panic and perhaps make investment decisions they wouldn't normally make under, say, quote unquote, normal circumstances. So, and that was something that we fielded a lot of calls earlier this year, people panicking, for various reasons when the market was down quite a bit. So again, just want to take some time today to maybe talk through that and, some points that you've made on some points to consider objectively, and also, how markets have responded in the past in those situations. So maybe if you could shed some light on that.
Absolutely. Thanks, Jeff. And you're right. You mentioned the emotion that comes into play when the markets do drop. And that's a very real thing, because we all don't mind volatility, terms of the ups and downs of the market when it's going up, when things are going in the right direction, so to speak. But the corrections, inevitably happen. And when those steep corrections do happen, it can be frightening, and there is uncertainty that's out there. And there can be, it can be a spur to take action, but in many cases, the action that you may want to take in terms of selling, after the markets have already dropped, that tends to be counterproductive because you have to get several decisions right, when that does happen. If you do, sell once your investments decline, then you have to figure out, when do I get back in, and then what is the right amount to get back in? And is it gonna drop again after I get back in? And what's going to be my trigger to do that? So it does get, quite complex. And the good news is there are some things that are within everyone's control to help ride that, out, and to help weather that storm, which we'll talk about. But just the fact of the matter is, you see these scenarios that we come across, like we did earlier this year in March, with a decline of over 30% in a very short time period. And when you look back at history, you actually see that steep market declines of about 20% or more happen about once or twice per decade. So it's not uncommon to actually see that happen in the marketplace. But when you're looking at your account balances and your statements, sometimes it will catch you off guard and by surprise, and it can be unsettling when you do see that. But if you expand your time frame and you look at these different periods in history, when we did have market corrections and various things happening across our world that impact the global economy, that impact our local economy, that impact the stock and bond markets across the globe, we can help put that into better context and then help understand that, boy, some of these things, while they can be unsettling, it's not that uncommon for us to experience, and stay the course to see what the potential recovery period could be. And I actually have a screen that I'd like to share, and this can help show what I'm talking about, Jeff. So what I want to show here is this is a piece that we've put out, and this could be available through Jeff as well. This is based on some Vanguard research, and here's a piece, a stat that I mentioned earlier, that we can expect downturns of 20% or more to be expected once or twice per decade. But if you think about it, this the slogan here is "This too shall pass," and this chart shows those periods going back to 1961. It'll show the 11 times this occurred going back to this December 1961 period. Not only does it show the percentage drop, so within this period, the market dropped 28%. And then, but how long did it take to actually recover? If you did stay the course and even invest more, how long until you have recouped some of those losses that you experienced with that acute downturn of 28%? And in this example, it was about 6.5 months, or so. And you look at this and you can see the numbers, down this chart. And you can see some pretty scary things happening here, right? Like 48%, 25, 33%, 49%, 56% during the Great Financial Crisis. And now what we've experienced earlier in March 2020 with the initial shock coming from the COVID crisis, we were down about 34%. And we have since had a nice, healthy recovery. But if you look at all of these things, going back to the Cuban Missile Crisis, Nixon's impeachment, you had, the oil embargoes, in the 70s, you had the Cold War throughout the 80s, Black Monday, the great market crash, in 87. You've had the tech bubble run, and then the tech bubble burst in the early 2000s, the great financial crisis, and now our COVID global health crisis. So there are things that happen that shake the markets. This shows that in every case, by waiting and staying the course and being focused on your goal, not focused on what the markets are doing in this current moment, it has passed. And you too, and as investors, all of us as investors, can have some things within our control that could help put us in the right direction and give us a better chance for investment success when scenarios like this do occur.
And Chad,
the,
I just want
yes,
to jump in for a second just to point. I mean, that chart I think is a great illustration. It's something we actually sent out something similar to many of our clients, back about 6 months ago, that showed historically, what's happened, and people tend to forget. You
right.
have so many good years like we've had recently, and you kind of forget that these events do happen and that we've recovered from them. And it's a good reminder just to show that, like you said before, once or twice a decade, these events tend to happen. It's just part of the cyclical nature of the markets. Um, and especially for younger investors who haven't been through those events, I think it's good, just, like you've shown here, to educate them on the fact that these events have happened before. And we now know, in light of, that chart, like you showed there, didn't show the endpoint, but we know that we recovered pretty quickly. I mean, the market
Yes.
fell, I think, the fastest ever, that it had plummeted, but it came back just as quick. So it's important to remain invested, because the markets do come back long term. The stock market has always trended in a positive direction. So I mean, I think that's a great illustration.
That's right, Jeff. And you make a good point about investors in different life phases, as well, and what to expect there, because what's in your control. Really, we think these are three powerful tools, for any market environment, but especially, when you were experiencing volatility. And that's to control what you can. This first thing, owning a mix of investments, this is perhaps one of the most important decisions investors can make. And that's really how you divide your money between different types of investments, more growth oriented investments like stocks, which we're talking about today in these, steep market declines. And this is really referring to United States, US stocks, in particular, in our domestic market in the US. But if you look at the mix of investments that you hold, in your account, whether your 401k, your overall investment portfolio, the mix that you have between stocks, bonds, and cash, growth oriented investments like stocks, more fixed income oriented investments like bonds, and safe, stable investments, like cash, that's going to have the biggest determining factor on your long-term returns and also volatility in your portfolio, more so than the individual funds or investments that you choose. So that mix is important, and having a more aggressive mix, more highly allocated towards stocks when you're younger and you have a long time horizon toward retirement, that time horizon helps you weather the storm in and of itself, because you have such a long time before you're depending on utilizing those assets to live on, to help supplement your income for expenses today. So that's such a key factor, and that's where great advisors, Jeff, like your team, what you do at Direct Advisors, and others can really help clients understand the right mix there. The second thing is, don't stop saving. If anything, when the markets go down, that, as hard as it can be to actually commit to, increasing your savings during those periods can tend to make a lot of sense, because as the markets are declining and the price per share of your funds is really going down, your contributions that are coming out of your paycheck and going to your 401k, they're still buying shares of whatever you're invested in each and every time you get paid and money goes into your account. So you're actually buying more shares when the market is down and your share prices are lower. So in a sense, you're buying the shares on sale compared to what they were before the downturn. So you're buying more, and that'll continue to compound for you even more so when the markets, recover eventually.
And
And
Chad,
then finally,
that's a great point. I mean, that's
yeah,
something that we stressed to a lot of participants back in March and April. And one phrase that I use all the time was, "This is when you make your money." During
yep,
these bear market situations, that's really when you make your money long term. Like you said, I mean, you're buying shares at a discount. Those opportunities don't come along that often. So the more you can buy during those times, I mean, that will pay off significantly, fivefold, tenfold, who knows, down the road. I mean, that's really when you have a good opportunity to grow your account in the long run.
absolutely, Jeff. And those opportunities, it can psychologically, it can be hard to commit and actually do that. But
Right.
if you do that and do it consistently, that behavior can really be a tailwind, to your investment success.
Exactly.
And then the final thing here is, keeping your costs controlled, and, lower your cost. whether it's your investment expenses and overall what you're paying for the access, that you're getting. One less dollar paid in expensive investment fees is one less dollar that's compounding in your account and growing for your own retirement. So, that keeping your costs low, it might be, counterintuitive in a way. In a lot of, areas, the more you pay for something, in some cases, the higher quality, it is, and, the better your outcome would be. But with investing, the evidence actually, points to the contrary. Actually, the less you pay, in fees tends to, improve your overall returns and relative, performance over the long term. So keeping, those costs low, it's something that Vanguard's passionate about. And, being an at-cost investment firm where, we have an ownership structure where the company is owned by the funds, it allows us to keep our costs, very low yet high quality, and have more of those investment dollars working for you, in your account, instead of paying an investment firm, very high profit margins. Not that we're against profit margins, but it's lowering the cost and keeping more of your money working for you is something that Vanguard's very passionate about. And there's many other studies in the industry that have shown this as well as being a huge determining factor of long-term investment success. So
Yeah,
these
we're huge supporters of Vanguard funds. I mean, we use your funds, I believe, more than any other fund family because of that low cost, indexed nature of most of the funds that you offer. We use your target date funds a lot, and like you said, that only just benefits the participants in the long run, helps their
yes.
returns. So we are huge supporters of Vanguard, and I know a lot of our clients and participants are as well.
Yeah. Thank you, Jeff. And it goes back to our mission too, to take a stand for all investors, to treat them fairly, and to give them the best chance for investment success. And doing these three things, owning a good mix of investments that's appropriate for your situation, your risk tolerance, your time horizon for needing the assets to help supplement your income. That continuing to save and even saving more over time, we recommend about 12 to 15% in terms of overall, compensation. Your pay is a good target. That includes employer and employee contributions. What's important, if you're not there, don't worry. But the important thing is to start and to be consistent and to increase when you can. And then keeping your investment costs, low, and knowing what you own and why. So those are three things that are within all of our controls, as investors and as individual participants in retirement plans. And we hope that some of these, tools you could implement yourself to really strive for a secure and confident retirement.
Yeah, Chad, those are all great points. I mean, that really echoes a lot of what we tell our participants all the time. Keep saving on a regular basis. Keep those regular contributions going in. Aim for that 12 to 15%. See if you can gradually increase what you're saving. And again, during these times when the market's down, as scary as it can be, that's the time, especially, to be doing all these things, because in the long run, you'll really feel the impact. So I think those 3 points that you made are all very valid points, and they're as objective as possible, which is really what you need is objective guidance during these emotional times. And because oftentimes, like we said before, fear can control us and cause us to do irrational things that we wouldn't normally do. So I think those 3 points that you made were very strong points that hopefully people will remember and keep in mind, because again, this situation will come up again. It's not
Yes.
like we experienced earlier this year is a one-time thing. We'll definitely see at some point again in the future. Hopefully not, too soon, but it will
Right.
happen again. So the
Right.
more we keep those points in mind, the better. So if there was one thing that you could leave our listeners with today, what would you say that is?
I would say have confidence and stay the course. Take stock of your emotions and of your goals, both of those things. When different scenarios occur, both in your personal life and in the external, factors, because really, as investors, we all have, competing goals. We have what's happening in our here and now, and whether our car broke down and we need to fix it. We're planning for the purchase of a first home or a new home or a vacation home or retirement, if we're so fortunate. All of those things, come up. And then we're looking for long-term goals, as well as meeting the needs of paying our bills and sending our, children or grandchildren, to school, college, providing for them, whatever your personal situation might be. So, if I could say, one thing with investing, it's do your best, regardless of what's happening, out there. And we are in interesting times, and there are going to be, as you mentioned, Jeff, there will be times when more volatility comes in on the downside. We have to be prepared. So I would say, as a parting thought, take control of your emotions and your goals. Understand, what you're saving for and why, and have the courage to stay the course. That's what I would say.
That's a great answer. I couldn't have said it any better. So again, thank you, Chad, for taking the time to be with us today, and bringing Vanguard's thought leadership to the table. Really appreciate that. And as always, we'll continue to be a supporter of Vanguard. And to anyone listening here today, if you need a copy of the memo that Chad brought up on the screen, let me know. Or if you'd like to get in touch with myself or Chad, let me know. And wish you all the best as we enter 2021. And we'll be talking to you soon. Okay, and thank you again, Chad.
Thank you, Jeff. Thanks for having me again. It's a pleasure, working with you. I hope this is helpful, for your clients as well. And I wish everybody a very happy and prosperous new year in 2021.
Thanks, Chad.
Thank you.